Hello, everyone. Welcome to today's session, 8 tax saving strategies your accountant is not sharing with you. All right. Okay, before we go to the main content, I just want to mention that the information provided here is for general information only. So before making any decisions, please contact an experienced tax agent, financial planner, solicitor, or one of our power planners. And we're not financial planners or solicitors and will not provide financial product advice, legal advice, and any other advice that's only covered by registered financial planners or solicitors. All right, so let's have a look at the 8 different strategies that you might not know or your accountant is not sharing with you. The first one is you could still potentially claim deductions without receipts, yeah, if you're eligible. And when you go to a tax agent, they probably just ask you, okay, what receipts do you have? But what if you don't have receipts? Okay, you can actually go through your bank or credit card transactions to support your claim if you meet ATO requirements. So generally, you need to have the description that's showing what you have purchased, who have you purchased from, so who's the supplier, and some other information ATO has requested. Provided if you can provide those details, you can actually use bank statement or credit card transactions to back up your deductions. Okay, this is actually something quite important. We had a client before who found more than $3,000, yeah, just by that one advice only that she didn't know. All right. And you should also check your online accounts, eBay, Amazon, Gumtree, and on some occasions, if you have enough backup information, you can also claim secondhand goods you purchase from Gumtree. Okay, and you can also claim laundry costs up to $150 without receipts if you have work-related clothes. And then also, if you have work expenses below $300 or less, you can actually claim expenses without receipts if you're eligible. And also for motor vehicle expenses, if you're using cents per kilometer method, you don't have to have receipts to back up the claims. Okay, and also home office using fixed rate method. So we can't cover all every different strategies, different tips here. So basically, there are many different ways you can look at to maximize your deductions, even if you don't have receipts. So in tax office on their website, there's a section with record keeping exceptions. So have a look at that section, that you can find out many other different ways if you have lost your receipt, you can't find it, and how you can still claim the deductions. All right. Okay, the second one, you can still claim car expenses even though you're not the owner of the car. This is a very common question we have received from our clients. And sometimes if they don't ask the question, they just don't claim it. They just believe, okay, this car is registered under a family member or under a friend, then I'm not allowed to claim it. It's actually not the case. Okay, so as long as the expenses are for work-related trips and you have spent the money and weren't reimbursed, you have a record of the expenses, the car is not owned by your employer and not under salary sacrifice, okay, and if the car is registered under family member, there is private arrangement between family members. So basically, you are the ultimate party who's actually paying for the expenses, okay? So if you are a private arrangement with your family members, that you are the payer of all the expenses, then provided if all those conditions are met, you can claim car expenses as deductions in your tax return. Okay, this can even extend to other expenses potentially if you're eligible. So we won't have enough time to give you more details here. So, but you can double check with your tax agent or contact us if you have more questions. All right. And number 3, look for multiple deductions from one expense. So sometimes there are multiple deductions that could be connected to only one expense. Okay, so people always feel that tax is rigid, but it's not. If you open up your mind, you can even brainstorm to find other deductions. Okay, one example we have listed here, cost paid for a training seminar. What are other possible deductions related to it? Okay, so you can actually claim home office expenses. So the hours you have spent preparing or reviewing the seminar notes before and after the seminar. And travel expenses, how did you travel there if it's in a separate place, location, away from home and workplace? Okay, if you have traveled there by train or bus, you can claim the fares as deductions, or taxi fare, Uber expenses, okay, etc., etc. If you have driven there using your own car, you can claim car expenses as well. Okay, and then also if you have used your computer, okay, to prepare and review the seminar notes, that means you have increased work-related percentage on your computer and mobile phone as well. Also, other things we didn't list here, do you have to buy a book or like maybe a notebook, stationery related to the seminar? If you do, then you can claim them as deductions as well. So when you only have one expense, open up your mind and think what other deductions might be connected to this one expense. All right. Okay, number 4. This is particularly for business owners. So you can claim eligible working meals as deductions. This is one thing that is interesting. Probably quite a few business clients, new clients, when they come to us, they don't know about this one. Yeah, I think most of the tax agents are not encouraging their clients to claim this one for some reason. But in reality, we sometimes do have work-related meals in our office, and they are definitely eligible to be claimed as deductions. Okay, so the first thing very important is you need to understand what's the difference between office meals and entertainment. Okay, entertainment right away is not tax deductible. Okay, unless FET, fringe benefit tax, is paid for it. Okay, and but working meals is deductible if it's meeting ATO requirements on why, what, when, where questions. So why means what's the reason behind? Did you provide the meals and refreshments to make employees more comfortable during the working day, okay, in the office? And what was provided? Is it only a light meal? It's not elaborate yet. And then also when it's provided. Is it provided in between working hours or when employees are working overtime? And where means did they consume the meals in the office space? Okay, so if you're meeting all those requirements, then you can definitely claim those working meal as deductions. So this something really important. This is not applicable to sole trader owners, okay, since you can't be treated as employees. So this is very important because sole trader structures, they are not separate legal entities. And then, but business owners as company directors, for example, or a manager for a trust, okay, for family trust, you can be treated as employees of the business. Then you are actually eligible to claim working meals similar to this, okay? All right, this is very important. Yet, I think not every business owner is claiming this one to the full extent. So make sure when they're eligible, you do include them as your deductions. All right, and FBT related exemptions. So for business employees, including business owners not in sole trader structures, you can provide FBT exempt expenses and claim the full deduction. So the full deduction will be in your business, okay? And then for the employees, including yourself as a business owner, who are receiving the benefits, it's actually tax-free. Okay, so some examples here. Electric cars purchased in the company structure and used by a director is fully deductible for the company and exempt for tax for the director himself. Okay, and next example, minor benefit below $300 can be provided to a company director, fully deductible in the company and exempt from tax for the director. Okay, so this one need to be infrequent, irregular for the $300. And then there are many other FBT exempt benefits. You can contact us or your tax agent or refer to ATO website for more exempt benefits. Okay. Okay, number 6 is consider long-term tax planning. So some examples we have listed here because there are so many different factors you need to consider, but we just listed a few here to show you what can be the considerations. Okay, so you can potentially shift eligible income or deductions to following year depend on estimated taxable income for both years. So the reason why we mentioned here depend on estimated taxable income is because let's say for an example, if you know next year you're going to earn a lot, like a much bigger income, or you might sell a property, you're going to have a big capital gain next year, then of course you don't want to bring deductions to this current year. You want to push it to next year because you're going to have a much bigger marginal tax rate. So you have to look into the future before you claim deductions. So I know normally close to the end of the tax year, people are rushing around to buy different items, laptops or any work-related tools or equipment, because everyone mentioned that it's going to help you with your tax, but it might not. Okay, if your next year the income is going to be a lot higher, your marginal tax is going to be a lot bigger. You want to shift your more deduction to the following year. So sometimes you can, if they're roughly the same, you can potentially shift your bonus from the end of the tax year to the following year as well. Okay, if you know, okay, you can receive a bonus maybe in June, you might want to talk to the employer, can I have the bonus to July to next year, so that you can even out your tax a little bit to different years, provided if next year your marginal tax rate is roughly the same. Okay, so next one is sometimes when people buy a rental property, they always set it up as 50-50, okay, for husband and wife team. But without looking at the future income for the couple, essentially might not be the best structure, okay? Because what if husband earn a lot more or have a much higher marginal tax rate than the wife? Then it's definitely not ideal to allocate more loss to the wife. Or on the other side, if the rental property is going to give a profit, you might want to allocate more profit to the low income earner instead of the high income earner. So this is very important, that financial modeling, or you want to look at the whole life of the rental property, including the future capital gain, okay, and the estimated future income of the couple, to understand which structure could be the best for both of you, okay, for the family. All right. And then next one, depreciation for rental properties might not be a good idea. So a lot of people don't know depreciation expense so related to the building. Okay, so the part that you depreciate for 40 years, that part of the depreciation will be added back when you sell the property in the future. So that means the maximum capital gains tax you might be paying, even including the discount in the future, okay, 50% discount, is actually 23.5%. So that's actually half of the top marginal tax rate of 47%. But what if someone's tax is actually at 19% at the very beginning, okay, or 19% or maybe 21% with Medicare levy, then it's actually not ideal that you are claiming depreciation as a deduction at the beginning, but then you actually pay more on capital gains tax in the future. All right, so this is really important that people should consider. Have a look at what's going to be your future income, what's your current income, to decide whether you should claim depreciation for rental property. All right, and the next one about super contribution. So more people prefer to, they always mention that, okay, concessional super contribution is a really good idea, but actually non-concessional super contribution could also be a good idea, where you, even though you can't claim initial upfront tax deduction, but when you are allocating more money to your super fund, you can actually pay less tax on the future income. So 15% of income tax and 10% on capital gains tax, okay, after discount. So this is very important. It's also important to look into the future, okay. Of course, they are just a few very simple examples. There are so many other factors you should consider, all right? Okay, so number 7, also for business owners, don't forget travel allowance, overtime meal allowance. So when you incur overnight business trips, you can actually claim a daily rate as a deduction without receipts. Okay, so the daily rate can include meals, incidentals, and accommodations for domestic cities. Okay, and then for overseas trips, the daily rate only include meals and incidentals. So for accommodation, you can claim separately. Yeah, you have to have the hotel bill to claim it separately. And then also overtime meal allowance is similar, so you don't have to have any receipt, okay, as long as the allowance daily rate is actually below ATO rate, okay. But this is only eligible for some industries. You can actually double check on ATO website to find out how to decide the industries. Okay, so some examples here. Let's say someone want to travel to Sydney, okay, and then the company can actually pay the employee, so including the director, okay, a daily rate at $350.70. This is the 2024 rate, okay. So every day you stay in Sydney, provided if you're not living in Sydney, of course, you're traveling to Sydney for overnight trips. So every day your company can pay you for this allowance, okay? And then you don't have to provide any receipt. Okay, and then the daily rate to China is at $240. So here, because it's an overseas city, it only includes meals and incidentals, okay? And then the overnight meal expenses is at $35.65 this year. Okay, so of course there are more details on ATO website. That's you have to meet the requirement, including daily diary, yeah, if you incur overnight trips to a different city. Okay, so that's number 7. Okay, number 8 is utilize 3-dimensional tax planning strategies. Okay, so 3-dimensional the tax planning there are all the 3 dimensions, you need to work together to maximize long-term tax savings. So the first dimension is to maximize deductions for each tax entity in the family group. So within your family group, you might have individuals, maybe there's family trust, there's a company structure, self-managed super fund, okay? So you need to drill in to each separate entity to make sure that you can maximize deductions for that entity, okay? So a couple of strategies we mentioned earlier, that's actually within first dimension, so including drill into individuals, how to claim more deductions, even if you don't have receipt, where to look for them. That's actually falling in the first dimension. Okay, and second dimension, look across family group best entities to allocate income and deductions. So that means, say for example, working meal, office meal, that's actually deductible for a company structure for a director, but it's not deductible as an individual. When the director is receiving a salary, the office meal is actually not deductible for the against the director's personal income. So that means you need to definitely only claim office meals in the company structure. So that's actually because it's only allowed deduction in the company structure. And then also at the same time, when you notice, okay, maybe super contribution is another good example, because within your super fund, you only pay 15% tax. Okay, that's the tax rate within super fund. Outside super is actually on your marginal tax rate up to 47%. So that means you want to shift more income to your super fund, okay, to achieve a better tax rate on your income. Okay, so that's an example for second dimension. Okay, third dimension is looking into the future to find the best ownership structures for businesses and investments. So this one is probably the ultimate tax planning strategy. Okay, that's including many years, 20, 30 years in the future. So that's mainly focusing on long-term tax planning. Okay, so to decide what's the best structure for rental properties. Should you have a family trust so that you can have family members to come in to help you to even up your tax? So many strategies like that, that's all falling in the third dimension. Okay, and when you have surplus cash, should you move some cash to super to achieve a better tax rate inside the super environment, and how much it can help you to save in 20, 30 years time? Okay, so that's actually all falling in the third dimension. And we actually have another YouTube session called Maximize Your Wealth, with 3-dimensional tax planning strategies to illustrate more examples on how much more powerful the related strategies can be. Okay, if you're interested, you can actually find that YouTube session and watch it. All right. So basically, this is what we have adapted from a real client. So if there's no strategy, the net asset is only going to last until the person is 84 years old after retirement. Okay, and if there are combined strategies, so all tax planning strategies combined together, okay, that person will never going to spend or use up all the net asset. It's going to keep increasing and keep going up. All right, so basically that's it. And here is a brief introduction about myself. You can pause the video to have a quick look, on my qualifications. And that's everything. So we are the accountants. We want to help people to utilize all the tax savings to maximize their wealth. So that's our specialty. If you have any questions, don't hesitate to contact us. So our contact details are here. So give us a call, drop us a quick email if you have any questions. And we are really excited to share all our knowledge with you to help you. And we want to show you how much we can help you to maximize your wealth. All right. Thank you so much for having this session with us. We'll see you next time.